My next guest expects a more muted performance from the Mag 7 around earnings. She's still bullish into year end. Joining me now here, Post 9, is Meena Flynn, co-head of Goldman Sachs' Global Private Wealth Management. Welcome to our program.
Thank you.
So how are you thinking about this group of mega cap names, which, we're winding down here on the earnings, and we still have NVIDIA about a month from now. But as a group, what do you think?
I think as a group, it's really hard to look at these names on a quarter-by-quarter basis. They're undergoing significant transformational change in the AI infrastructure and everything that comes from AI. I think it's going to play out over multiple years. And so our clients are really looking at these names from a more longer-term perspective. And these businesses have significant moats around them. And we do believe that they're going to continue to outperform from an earnings perspective. That earnings may decrease in terms of outperformance, but we do think that the setup is still strong for them.
How do you feel about the market overall? We're obviously going to put in, barring some surprise over the next couple of months, a really good year again. Have we borrowed from 25? I mean, how does the landscape look to you?
We're pretty constructive. And the reason why we're constructive is that we have global growth growing at 3% on a real GDP basis and U.S. growth growing at 2.5%. And usually the best predictor of forward equity returns is the economy. So 90% of the time, when you have a strong economy, you have positive equity returns. So take that to the S&P 500, and we anticipate earnings growth next year of roughly 8 to 10%. You couple that with a 2% dividend yield, and you're looking at 10 to 12%, and you could even have some multiple contraction and still have pretty positive returns.
So we justify where the multiple is of the market. I mean, that's the question now. Is like, well, our stock's too expensive, and as a result, if earnings growth slows, then we are at risk of below average returns for the next couple of years. There's going to be a downturn at some point in the economy, we think.
Yeah, no, I mean, absolutely. But as we're looking forward, we actually do think that growth will continue to be robust. But I think it's really important that you put it in the construct of a total portfolio when you think about portfolio construction. And the number one thing that we do with our clients is we do actually really think about their risk objectives and help them implement a portfolio that's going to keep them from selling during periods of market volatility will also outperform inflation. And so our clients' portfolios are really comprised of a ballast of fixed income, equities, and alternatives. And we seek to implement that for them in really fee and capital efficient manners and take advantage of volatility.
I mean, when you come to, we're talking about clients of Goldman's private wealth. Obviously, we're talking much beyond the 60-40 portfolio. Clearly, for high net worth investors, the construction is going to be far different. I don't know, what you think about to what degree you should have alternatives as part of your portfolio. I've heard 50, 30, 20. Private equity, private credit. It doesn't seem from what we hear that the money flow into alternatives is slowing down anytime soon.
No, and nor do we think it should. We recommend on average roughly about a 25% allocation, but we do have clients that run a much higher allocation. It really goes down to one's risk preference. But really, if you look at big picture, why are we constructive on alternatives? There's three reasons. The first one is that given they don't mark to market on a daily basis, they actually put the emotional side of investing to the side. The second thing is that the investable universe in the private space is larger than it is in the public space. So if you look over the last 25 years, the number of companies that are public has gone down, but the number of private equity-backed private companies has increased sixfold. Additionally, given the amount of money that is coming into private markets, they're able to stay private longer and have a tremendous amount of value creation before they go public. That being said, we recommend that we leg into alternatives for our clients. So while I said 25%, we get there over a 5 to 6 year time period so that our clients aren't geared to any one vintage.
I mean, as more money continues to go into things like private credit, it only increases the duration that a company would, remain private for longer because they just don't need to tap the public market for liquidity.
Yep. No, absolutely. The private credit, we do see that market is going to continue to expand. And if you look at first lien senior secured loans right now. They are yielding 10% plus on an unlevered basis, so very attractive for investors. But there's also much more beyond first lien senior secured loans in private credit. So you do have things like non-traded investment grade and asset-backed securitizations and stuff like that that our clients are able to take advantage of and really just toggle that risk reward. And like you said, companies are able to use this to be able to help their capital structure and go public when it makes sense for them.
I mean, the movement in interest rates obviously impacts the kind of return you would get in something like private credit. So, I mean, how are you gaming out what you think the Fed is going to do? And have you reset your own expectations as a result of what's just happening in the market?
I think you've seen yields widen out by roughly 40 to 50 basis points since we had the last Fed cut. And I don't think that's actually because investors are concerned about anything other than actually we've had a stronger economy and the Fed may actually cut less. And so we still are expecting 25 basis points next week and 200 basis points through the cycle. But the Fed has some room. I think the bigger question when you think about interest rates is at what point do investors start talking about the fiscal deficit? And so we've got, a debt to GDP right now of almost 100%. You've got fiscal deficit running 6 to 7%, and you couple that with strong growth at an unemployment rate of 4%. And so that's something that we don't think we're near that tipping point, but we do think that, investors are looking for that to be addressed.
Yeah, I feel like investors are talking about it and are concerned about it, but can't do anything about it. You need something to happen in Washington to deal with the deficit. So we'll see how it all comes together.